I'm Dave Cates, President and CEO of Denison Mines. Denison is traded on the TSX under DML and on the NYSE American as DNN. We're an Athabasca Basin mining, development, and exploration company focused in uranium. Our flagship asset is a development project, Wheeler River, with the Phoenix ISR mine, which is scheduled to be the first new large-scale mine in the Athabasca Basin in a decade. And we are recently celebrating the success of our McLean North mine, which has come into production with our joint venture partner, Uranium.
David, good to see you.
Matt, wonderful to see you.
One of the
home
big
turf here.
Home turf. You're very welcome. You're one of the big boys, but not compared to one of the other attendees. We hear Microsoft's here.
Yeah, I've heard that too.
Everyone's talking.
Sounds like they might have joined the WNA. Isn't that joyous?
Yeah, but is that good news for you? Do you care?
I think it's very good news.
Right.
Look, we've seen the developments with Microsoft in terms of supporting nuclear energy to supply power to their data centers.
Mm.
The fact that they're joining and publicly joining the WNA, I think is really icing on top of the news stories that have already occurred, and just really a public declaration of their link to nuclear power. They're a major player, obviously, and they use a lot of power. So we're happy to have them in the WNA and being public around nuclear energy.
Well, it sounds like the demand side of the equation is doing what it should be doing, which is, finding the money to build SMRs, to restart reactors, to build new reactors. It's doing a damn fine job. The supply side, that's you boys, not so much, but a few negative stories over the last 18 months in terms of guidance coming down from Kazatomprom, from Cameco.
In terms of uranium mining is a bit challenging.
Who knew, right? But that's kind of good news for investors, isn't it?
Well, I think the two together works really well.
Yeah.
The dynamics right now are really positive. I mean, the demand side is, let's say, outperforming, which is excellent. The developments are across the globe. Data centers are not. It's recognition of the importance of nuclear energy. Really, it's not in debate anymore at all.
Yeah.
So that's rock solid, and honestly, most of the models don't even really project demand growth anywhere near where I think many people expect it to go. The supply side, you're right, has really been a struggle. We've seen the restarts and the incumbents. They're the first wave of people to come back from our terrible times in the sector of low price. We have to remember that restarts are mines that were shut down. So in some ways lower risk in that, they're not building a new mine from execution standpoint, but they're also mines that were not the top tier. So, this is an analogy I've used, and I don't mean to be offensive to any of the folks that have restarted, but it's a bit like taking a used car out of storage, right? Like a new car, usually reliable. That's why you want one. Has a warranty, that kind of stuff.
Yeah.
The used car, and then putting it in storage and then trying to bring it back to life, it's not that easy. And then when you do get it back to life, it's still a car that's been driven for whatever amount of kilometers it was. It's not a new car.
Yeah. I've been using barn find because I think it's worse than that.
Oh, barn find. I love that.
It hasn't been used in a long time.
Right. Needs restoration
and
all that. Yeah, no. So I think that's a reality now, is that we're seeing that's a challenge.
Yeah.
The incumbents, and this is the Cameco would talk about the incumbent revolution that would be coming to them, and they would be positioned to benefit from a improved market. They're also struggling. We've got Kazatomprom. It's had multiple years now of struggles achieving production guidance, and Cameco recently announcing that they'll fall short this year as well. Look, uranium mining is complicated. It's tricky. There's a level of risk. So the idea that we will have a perfect supply response to evolving and increasing demand is something that's probably unrealistic. And then where I think it's really interesting is, where would the new supply come from? So the lowest risk sources of new supply would be in the hands of the most capable and largest and well-financed companies, like our majors. Well, we don't have that many majors. Kazakhstan has its stable of projects. The pipeline is not extra deep, and they're barely keeping up with their guidance. It just is what it is. Cameco doesn't have major growth projects on the horizon. They've not been investing for a decade now. Where are the new projects? Well, Denison obviously has one. We like to think it's a leading development project with Wheeler River. NextGen's got an excellent project with Arrow. Outside of that, if we want to meaningfully count pounds, you're mostly looking at independently owned projects that are in Africa. Difficult jurisdiction, and you're relying on companies that reasonably didn't have much infrastructure or much in the way of an actual operation in their company for the last 10 years. It's incredibly difficult to all of a sudden go and build a uranium mine. This is a tough fact pattern to believe that supply will all of a sudden come to the market and meet the call of demand when we can't be relying on the majors to turn their pipeline on. They don't have a pipeline.
But yeah, I mean, you've got a couple of projects in your portfolio which long before the current incarnation were discovered 30 years ago.
Yeah, so Phoenix, for example, will be about 20 years from discovery to first production, discovered in 2008. And we've worked it through all the bad years, which is the difference maker. Yeah. Many of these projects, globally, there was a 10-year period where you would be crazy to deploy money.
Right, it's not unusual.
Well, from the
we're not saying it's a bad thing, I'm just saying that's the reality of how long it takes, right?
Correct. We would say we're an outlier to be able to have invested through all those bad years. That's a major difference maker right now in terms of where we are in the queue. Yeah,
so I don't want to get into the kind of demand, because like I said earlier, I think we could spend 4 hours talking about this. Something sort of super exciting news, and some people yell at you about catalysts again. We got enough. Suffice to say, it is difficult. Africa is people look to it, but it's had its own difficulties in Niger, obviously, as Global Atomic will tell you.
Well, even just the economics of those projects, they're not there.
Yeah,
right?
absolutely.
We're not that close to them being there.
No, incentive price, which everyone's been wanging on about for the last 6 years, is still true and still alive today. What that number needs to be, I think people are going to be changing the economics around that. I think in view of having these, Peninsula, in view of Encore, in terms of Paladin, Kazat and Cameco, all experiencing more significant difficulties than the economic study would suggest. Correct. So I think that there's going to be a new number. I don't know what that is, but I'm excited to see what people start talking about. Let's get to you though, right? Because I've had great conversations with explorers in terms of how they have to adjust to the market conditions, in terms of the demand driver, the announcements coming out, and have access to capital, cost of that capital, and even the developers, early stage developers, talking the same game. It's like, I've got to react to the market. As I said at the outset, you're one of the big guys. Do you have to adapt and change the market conditions?
Maybe a little less than people would think.
Right.
And that's owing to the assets we have. So we've been on a path of execution for several years. Like the primary way we're going to drive value for our shareholders is re-rating from developer to producer.
Right. So that's it.
Right. And we have to execute on that. We didn't need the price to go up for that to be our strategy. Yeah. That's the uniqueness of our project portfolio. We have low costs, bottom quartile of the cost curve, multiple assets. We've been able to pursue that objective, but really it's execute on Phoenix, generate the cash flows from that, allow us to redeploy into Griffin, extend effectively the Wheeler River mine life, but all of that's to drive a valuation in the market that's greater than NAV. It's a kind of a crazy thing to say that, but in our sector, because of how scarce the uranium market is, the producers trade over NAV. Today, we're discounted NAV, typical for a developer-focused company. Realizing on the project, building it, executing, generating cash flows, we should expect to trade above NAV. And that's really where we expect to generate the return for our shareholders. If the uranium price moves up from where we are, then the return will be greater. But the fundamental return that we're driving is going from discount to NAV to premium to NAV on re-rate.
Right, okay. But people will look at it more simply than that and say, well, why would you want to produce pounds and sell them for less than you could in a year's time, 2 years' time? Because the uranium space is very good. Lots of people telling me what the future will look like, which is quite remarkable, including the price. So, but you have to take a different view of life, because I say it comes back to what you're saying. What's the best allocation of our capital today for the moment where we start to produce cash? tomorrow, right?
Look, I mean, we're maybe a little old fashioned.
Yeah.
In that we believe our objective here is to mine uranium
Right.
at a reasonable price.
Yeah.
Generate profitable margin.
Yeah.
Which will generate positive cash flows, which we can redeploy to generate
but
further returns.
You could people argue and say, like, okay, you could have said that, like, say 3 years ago, 4 years ago, and then tried to do it, but this incentive price argument keeps coming through. Why is now the right time to do it? Why not hold back until you've got more clarity about? So the demand is there. More clarity on what the pricing will be and what price utilities are prepared to pay.
I mean, at the end of the day, we will participate in that future market too. But we also will be generating positive cash flows and driving a premium valuation on the way there.
Right.
There's growth that allows us to exploit that evolving market, and we do it then from a position of economic strength on positive cash flows without relying on equity or other sources of financing to get us there and diluting our shareholders.
Explain that for people, because I think it's important, because, like I say, when I want to deal with that, because we get that in a lot of why you're going to miss out on another $50 per pound.
What matters to the shareholder?
Time cost.
What matters to the shareholder? Share price goes up. Okay, to get to the future without mining the uranium, there's a cost. Right? Where does the money come from? It comes from somewhere. It's usually going to be a share issuance or something like that, which means the number of shares is going up.
Yeah.
Our asset value in that case is maybe going up if the future price of uranium outpaces the time value of money. But if it doesn't,
and still inside, we're not generating capital anyway. So it's a continuous.
You got to get off. You got to get off the dilution treadmill.
Okay.
We've already done that generally with our balance sheet. Now it's about generating cash flow. And then turning the cash flow into greater returns.
Right. Is there any such advantages, first mover advantage for you? Does it matter?
Well, look, I think it does. It's not in a careful way to answer this. Like, it's not about getting in before the door closes, but there's going to be, in my mind, incredible value to being in production, having uncommitted or market exposed production at a time when the market realizes that there isn't actually enough.
Right.
So while that will be good broadly for everyone, because the value of everyone's unmined uranium will go up because of how scarce it is, to be actually in a position to sell your uranium and realize that price and turn that into cash, that's what our first mover advantage will do. It actually positions us to be ready for when the price is higher, to then sell our uranium. That's actually the business, right? Is to have the uranium to sell when the price is higher.
I've been having this conversation a lot in the past few days, which is around, and if I go back to the last cycle, in banking, we were like, pounds in the ground. You do the math on that, and you go, I think that company's worth X, right? And they were ludicrous pricing, because pounds in the ground was the only mechanism by which you were judged. Now it seems, I guess, because also the last cycle, not a lot of actual new pounds produced. Let's be clear.
Sure.
This cycle, people showing us how hard it is, how expensive it is. That's going to be part of the calculation going forward. What does it look like when it comes out of the ground? Actually, not on paper, in theory, actually. And as a first mover, you're demonstrating a route to market. You're demonstrating capability to the market, right? And you're also generating dollars, which is quite nice. So there's a lot of positives there. Did you think that allowed you to kind of, like, almost step forward, roll forward quicker than the guys behind you as a result? Does that create more buying opportunities? I know you've got a big portfolio, but you need different profile of assets, surely.
Well, no, for sure. Look, being in a position where Phoenix is producing and generating incredible free cash flows gives us great flexibility. I mean, we would want to generate a return on those cash flows. You have options of building internally or acquiring, but to be able to acquire without having to dilute is an incredible opportunity for us. Now, we do need discoveries to be made. I think this perception that there's an enormous amount of undeveloped uranium globally is not like statistically wrong, but it's like realistically wrong. We've looked in our region for the last, since 2018 for deposits that we could ISR mine. It's not deep with a bunch of underexploited assets.
Yeah.
So we do need the COSA resources of the world, the foremost clean energies of the world, and the sky harbors of the world to have success. And then if we're generating that cash flow from Phoenix, we're the obvious place to take an asset like that they've discovered, turn it into cash flow.
Are you looking at different ways to kind of hold parts of assets that you identify? Because it kind of feels like there's a lot of, pardon my French here, folks, shitty assets out there. People telling me they're good, and it's kind of like two men in a wheelbarrow type of territory, with a good storytelling and a banjo, and it's all great. But no one's going to make money from those. But there are a few that you think actually those could be. So I know you named a couple there which you bought into, but will you do more of that as part of your exercise? Because you've been quite good on your balance sheet. I quite admired that over the past few years. Is this more the style or?
Well, our eye's been on the prize, right? Which is being financially stable to execute on our projects and not be vulnerable to market dynamics, right?
Right.
But we do, as we're this close on executing on Phoenix, we're generating some cash flow from mining at McLean. We are looking at, Phoenix will be built quickly. We're expecting permits in the first part of 2026, and it's a 2-year construction timeline, which means production by mid-28. That's not that far away. It produces in our feasibility study, and based on all of our test work, it looks like it will ramp up quickly, right? High grade Athabasca.
What are you aiming for again?
Well, up to 9 million pounds a year first 4 to 5 years. And look, you've got small well spacing, high grades. So this is something we've demonstrated is possible, that it'll ramp up quick. That does have our mind already turned to, well, geez, that could produce $1 billion Canadian a year free cash flow, depending on your uranium selling price. What would we do with that? So we have turned our mind to staging a growth profile. It's not to take our mind off of the prize, which is Phoenix, but realizing that ahead is another trap for the mining development company, which is successful mines, operates, ceases to operate, no new mine, no growth to feed or to reinvest in. And so we are looking at multiple things. One, we're spending more money at Griffin, which is the other deposit at Wheeler River, to stage it for redeployment of Phoenix cash flows. But two, we're looking at exploration. We've never stopped exploring in our portfolio, 10 to 15 million Canadian a year for as many years as I've been responsible for it. And now we've got these transactions with the junior Athabasca team, we'll call it Team Denison, where we've taken assets, in a couple of these cases, assets that we were not going to work in our portfolio while we focus on Phoenix. And we've partnered with companies that will work them. We'll fund our share of the project, we'll fund our share and maintain equity interest in those companies, but we keep the assets being worked because we need exposure to those discoveries. Anybody who's not in Team Denison has success finding an ISR amenable uranium deposit. We monitor everything, right? We absolutely would see value that we could create by acquiring if the deposit made sense for us.
Okay, remind me the balance sheet, because you've kind of got this. You've got an ATM.
We have no ATM.
No ATM.
We have no.
Sorry, you
shelf.
did the convert.
Yes. So we have physical uranium. Roughly 2 million pounds physical uranium. Right. We've just completed a $345 million US convertible bond offering. Which we'd love to unpack a little bit because it's a little bit complicated. Then we had cash on hand. So if you put it all together, we're we have a few other investments as well. You're over $700 million. Balance sheet.
Right. So coming back to the original question, which was, do you need to bow to the market's will, or do you feel a bit more in control because of the advanced nature of where you're at?
We sleep well at night, knowing that our project is on the cusp of approval. And when it's approved, we don't need to
go to the market. We talked about that back in where I think we were in March.
So you're gonna love this. We're in the final stages.
Thank God.
Of the regulatory approvals process. I'm calling it
version 5.
Exactly. I'm calling it the approvals receipt phase, because that's really all that's left.
Did the panel sit?
No. So the panel is scheduled to sit, which is actually an incredible accomplishment. October and early December. 2 seatings, 1 hearing. We did receive provincial approval for our environmental assessment. Just this summer. So what's left is provincial approval of our pollutant control facility permit, which is basically a license. That's not seen as being on the critical path. That's in progress. And then we need the federal approval for the EA and the license to construct.
Right.
And that's what those hearings will consider.
Right.
Decision should be rendered, we would expect, within 90 days. That's the CNSC's guidance, roughly 90 days from the second part of the hearing, which would put us into Q1 2026.
Yeah. Okay.
So that's around the corner.
Mm-hmm.
You know, and look, with the financing and then the balance sheet where it is, what we will be waiting for is the approval.
Right.
You know, the detailed design engineering is already over, total engineering over 75%.
Yeah.
Procurement's been in progress since 2023. We'll be at 95% plus on total engineering by the end of this year.
And procurement, how much more?
Oh, well, procurement will be ongoing. I mean, we've basically been procuring the items that we will need so that we construction timelines.
So in a percentage term, like you did?
You know, we'll probably be, I mean, we have a budget this year of over $70 million for completion of engineering and procurement.
Right.
I think we're committed already around $70 million on procurement.
Right.
And we're probably in 20 to 30 million spent.
So to go and get $1 billion a year by building this thing out, 4 or 5 years, $700 million, how far does that get you in terms of the build?
Well, the capex from the feasibility study is 420 million Canadian.
Okay.
So that's a 2023 number. There's some level of cost inflation that people should expect. The street has, you know, a variety of estimates on us, you know, between like 450, 550 million Canadian capex.
Okay.
We're not vectoring out of that range.
Right.
So the 700 million funds the execution of the project.
Okay.
What is more variable to us is how much we invest in growth.
Yeah.
But the story is equity dilution. Any level of that is off the table.
Yeah, and I guess with the money you're generating and reinvesting, you'll come back with various degrees of ambition on that front. That's fine. On the convert, which is you say a big chunk of change. That's a decent sized convert. I don't think I ever did one that big in my life. 200. 375. So
345 US, yeah.
Oh, okay, so conditional is what? What are the conditions precedent?
Oh, it's already drawn. The deal's completed.
Nice.
Yeah, so it's a US style convert.
Mm-hmm.
And that's been something we're educating a little bit on.
Mm-hmm.
It's a little bit different. It's quite a lot different actually than the sort of conventional Canadian mining strategic convert.
Yeah.
You know, in the conventional Canadian mining strategic convert, I'll call it, the idea is the only way the investor can capitalize on the conversion element is by converting and taking the stock.
Yeah.
And so people, of course, then measure out, well, how many shares will that be? Right.
Uh-huh.
Totally logical.
On the full amount?
Well, that's what people do on the conventional converts.
Right,
They think about that, right? Because look, if you've lent $100 million, but it's convertible and you want to benefit from the convert, you got to convert it
my
into stock.
8%, it's all good.
Right. So this is a US style convert that we've done. And so what's critical about that is that when converted, the issuer has the choice of how to settle it.
Yeah.
And so we can settle the bond in cash, stock, or a combination at our election, which means convert goes up in value. Well, say share price goes up in value and the conversion is in the money, we can still settle it in cash. And what we've done with this convert is we layered on a capped call. So this is the first time this has been done by a Canadian domiciled TSX listed company, where we've taken the US style convert and put on a cap call. It's very common in the US to do this. Here, it means that the conversion to Denison is now effectively only potentially dilutive if we're up over 100%.
Yeah.
So it would be like 432 US share price before we wouldn't have capped call coverage. So that's quite different. So essentially, until our share price is over 432, we can settle the conversion of this bond or the units of the bond by paying back the principal in cash. That's all we would be.
That was done by US banks?
Yeah, it was brokered by Cantor Fitzgerald and Scotiabank.
Okay.
And then the investors are basically US, Canadian, and Euro convertible bond funds.
Yeah, not many of those. It's good.
surprisingly more than you might
No,
think.
exactly.
It's quite a lot, yeah.
Yeah.
but they're not really investors in our sector otherwise,
Mhm.
because they're not equity investors normally. They're looking for convertible bonds.
Yeah, yeah.
So again, the story is important for people to grasp that, like, in many ways, this instrument will work like a regular, like, bank debt, in that you can pay back the principal without issuing stock. And so with the capped call, up to that 432 share price, the value of the bond goes up, but we generate a return from our capped call equal to the value of the bond's increase, meaning that we can write our check for 345 US, plus take our proceeds from our capped call, which is basically up to another 160 million, and use that to settle the bonds without having to issue any stock. So on our website, we have a special slide deck for this convertible on our investor presentations tab. And the example shows that if our share price goes up 200%, so we're talking US like 650 range, and we pay back the face value in cash, and we use our capped call to cover up to that 432 share price appreciation, and then we settle the rest that we'd still owe under this 200% share price case with stock, you get to then use the present share value, which is 650 a share, to settle that difference out. It's only about 39 million shares, which is 4% dilution. So we're up 200%, and this convert has the effect, if we use that repayment model, of only 4% dilution.
That's good.
A lot of people don't follow that, and I appreciate having the time to walk through it, actually.
I thought it would better, because if that's the question you're getting about, oh my goodness, the dilution coming down the line, that should hopefully calm.
Look, we wouldn't have done it without the capped call. And the capped call shows the market that we're bullish that our share price goes up more than the 35% basic conversion. Right?
Okay, and between now and then, what's it costing you?
Well, we've already bought the capped call.
Okay.
So we spent $35 million to buy the capped call.
And stuff.
4.25% coupon. That's it.
Oh, good. Not bad.
It's excellent.
Yeah.
I mean, we estimate this structure saves us over 100 million US on interest costs compared to the best conventional secured project finance that we could have gotten as an alternate. So that's incredible savings.
Good. Absolutely. Okay, not bad. Right, back to you and what you do with said money. Obviously, getting production, getting cash flow, all those good things. You talked about maybe being able to kind of look around the market and doing deals with some smaller players. Can you give us your thoughts on the market as you see it with all of these other players? Like, you're at the top end, you're at the top of the table, ready to go, along with not many others, right? So it's all good news for you and your investors. When you're sort of looking around the market, the things I've not liked some of these companies perhaps coming back lowering guidance because it says life's a bit harder than you realised. What we don't want is anyone falling over, because then that scares everyone away from the sector as a whole. But you're at that point now where you're talking to utilities, having serious conversations now, presumably.
Correct.
And I guess you can't agree till you've actually produced, but are you happy with the sorts of terms that you're starting to see? Do you believe that's a good deal there?
We're deep in discussions with utilities, and there's the prospect of reaching agreements before we produce. The utilities have an incredible thirst for new sources of Western and in particular Canadian supply. They're already filled up on Cameco. They risk manage extensively, the utilities. Concentration of supply with one vendor in Cameco, they're at the max on that. They absolutely are looking for additional sources of supply, so they're very interested, and we're in many discussions. Broadly, the terms that people are reporting is in terms of what the market action looks like. We'd say are consistent. We're seeing those types of floors, ceilings, whatnot. The things that we're more focused on is that we've not rushed this. We've not needed contracts to access credit, for example. We've not needed floor prices or fixed prices to be able to go get bank debt. We've done our convertible. Now it gives us latitude with our physical uranium to monetize it over a more measured timeline, a little less urgently to pay our bills, but also, working with the utilities on structures, we're focused more on the utilities that understand the risks of new production and flexibility, things like that. So it's incredible to see how many of the utilities do have an appetite for that.
Well, I think I have to, because you'd be a new producer effectively. 9 million pounds is a great number, and ramping up to that, I'm sure there'll be fun games along the way. But they will buy in bits and conventionally you'd say, oh, they'll pick up 2-3 million pounds from us. Sorry, 2,000 pounds from us, and they'll build up there when they get confidence. Right now, given the scarcity we're talking about in the marketplace, that flexibility, does that flexibility looking like it's actually we need flexibility to option more of this? And do you feel more in control now than perhaps it would have been a year ago in terms of the financial discussion as a consequence?
Yeah, I think these things all relate. Having the convertible bond deal behind us gives us confidence on execution, but also means that the utilities are more confident in our execution. But also means that we're
money
less
and execution are
reliant
two different
on
things, right?
Yeah, no, agreed. But
it gives you money to give it a go.
We can all see that we're funded to do it.
Yeah,
and that helps us in our discussions with them. But it also means that we're not necessarily looking to them to fund the project.
Yeah, I need you to get the money. You're like, we've got the money, now let's talk turkey.
Correct. We have a very low cost profile in the project.
Okay.
We don't need to sell every pound in advance. We don't want to swamp the spot market either. And there's few people that have as much experience as I do with the spot market. But, we have flexibility now. And we are able to start engineering contracts that work for us. But we also want to be mindful that, you don't want to sell all this production at one point in time.
Well, tell me about this, because you've got Next Gen, right?
Yeah.
Right, 20-30 million pounds they're talking about being able to dump into the market. So you guys are going to need to be quite careful and talk to each other, I suspect, which may not be
I'm sure we're not
allowed to do. But you're going to be quite careful there, because you got to hope that when the US is saying we need to kind of triple from 50 million to 150 million in whatever time frame that they've decided they want to go for, you got to be damn sure you aren't going to flood the market, and the others coming online roughly around the same. Could you maximise this?
I think we're in a
unique spot.
I think we're in a unique spot because of our quality of our asset. So, like Next Gen and Denison, broadly, I don't think either of us sees each other as a threat. Okay, we both have top tier assets that persist to survive in really every market scenario that you could imagine. There are certainly scenarios where the market is very robust or a little less robust than expected. We will survive and thrive in all of those. We're mindful, though, that the market could go a few different directions depending on the bigger players than us. And it's not to say that we're not a meaningful contributor to the market, but realistically, Cameco, Kazatomprom, and Next Gen are working with bigger stacks of uranium that have more potential to influence the market. So in some ways, just realistically, we will be a taker to where the market goes. We are engineering our commercial strategy in light of that. And that means that we will have a diversified book of different types of contracts, because some of them will work out in some situations, and the other structures will work out in other situations. So two things that we're trying to do is be diversified in our types of contracts, and then we're trying to average, right? Like, we talked about the price will be better tomorrow. Probably will. I believe in that.
Yeah.
But we will have more pounds to sell tomorrow, right? So we don't mind the idea of participating in the market over time and averaging into it. Selling some in the near term, selling some next year, selling some the year after, having enough sold that we can reasonably place our production for ramp up. All of that's good, but we don't have to sell it all.
See, that's brilliant, because it comes back to that whole control bit of the conversation from much earlier, and also making sure you're maximising the dollar return for that pound out of the ground.
Correct.
Okay,
Correct.
So I like that. You're thinking about it. I think my CEO said to me today, he gets that nasty emails from people telling him how to run his business with lots of ideas.
Well, everybody gets those.
Yeah. No, it's like, thank you for your ideas. We had actually discussed and thought of that. Okay, so life is good at the moment for you guys. Obviously,
we have a lot of hard work ahead.
But
a lot of hard work ahead.
I was going to say the money's there, but a lot of hard work and execution.
Yes. A lot of important stuff has already been completed to get
Yeah.
us to this stage, and
Yeah.
we're now this close on execution. And look, I think the thing that's least talked about that's actually pretty notable is that we are back in mining with our McLean
Yeah.
North mine
Yes,
with
I was
Uranium.
also with that,
And it's, ramped up, and I was there for the ribbon cutting in July, and
What are you guys
project
got?
is
23-24% of
we're
that?
22.5%.
27% of that,
Pretty
right?
good.
Okay, yeah.
And that's pounds that we can market independently. So when
Yeah.
we go to those utilities, we kind of have a unique offer right now.
Yeah.
It's we've got current production from McLean that's
Yeah.
uncommitted.
Yeah.
We've got inventories that we can sell anytime, basically through to the end of 27.
Yeah.
So that would fund our operation and
Yeah.
construction, and then we've got Phoenix to offer them.
Yeah.
It's pretty dynamic.
Very good to see you, sir. Good to see you. I mean, it's exciting times for you boys, especially at your end of it.
I always
Yeah.
appreciate your interest and all your efforts in this sector.